Hello everyone and welcome to another episode of what the unexpectedly high inflation is doing to the stock market. Today I thought we would talk about why the stock market and share prices go down when the inflation is high. So after this video I hope you will have a better understanding of which stocks and companies will be most affected by the inflation we're facing right now. And maybe you can use it if you want to try to find good companies to invest in right now. First, we need to distinguish between expected and unexpected inflation, because it's the unexpected inflation, as we see right now, that affects our stocks the most. We must also distinguish between temporary inflation from more permanent inflation. So the prices of an asset can temporarily rise without affecting the stock market. Say for example that one of our power plants stops working. Then the electricity prices would temporarily be slightly higher and affect the inflation. But as soon as the plant is fixed again, the prices will fall back to normal. This would have a minimal impact on the stock market, as everyone would expect the prices to normalize quite quickly. So first of all, the prices of stocks is more affected by higher and more volatile inflation because it brings more economic uncertainty. The uncertainty affects the companies by making it more difficult for them to plan for the long-term business when the future price situation is unknown. At the same time, it also becomes more difficult for us investors to predict the company's future earnings, which is what the share prices are based on. At the same time, companies' margins are often reduced, as all cost increases cannot be passed on to the end consumer. Secondly, unexpected inflation can be followed by economic weakness. An overheated economy that causes high inflation may in the short term increase companies' incomes, but if the inflation persists, it risks leading to worse economic times, a bit like what we are seeing right now with the looming recession around the corner, if interest rates are raised too much too quickly. This will of course affect many companies negatively, which means that share prices may fall. Thirdly, companies with high capital gains risk receiving high taxes in times of high inflation. After all, the profit is calculated as the difference between the purchasing price and the selling price and doesn't take inflation into account. So imagine that a company buys an asset for $100,000 and sells it 3 years later. If we assume that the inflation has been 5% during this time, then the asset must be sold for at least $115,763 just to compensate for higher inflation and not to have lost purchasing powers on the investment. If the asset is sold for less but still over the initial price of $100,000, the company has made a loss in real value, even if it counts as a gain in nominal value. So the company still has to pay taxes on the profit. The higher the inflation, the more the company have to sell the asset for just to break even and not lose purchasing power. But the tax will also be higher, so higher inflation eats up value for the company when they sell a capital asset. And more taxes means less money for example, investments or share dividends, and thus lower the value of the stock. The fourth reason is that inflation, and especially unexpected inflation, increases the risk. It simply makes it more difficult for anyone to predict future earnings for a company. And since share prices is based on future earnings, investors may want a higher risk premium in more uncertain times with higher inflation. And by a higher risk premium, I mean that you want to pay a lower price for the stock now compared to what you expect it to be in the future, because you're taking a higher risk in uncertain times. And when you take a higher risk, you want a higher expected return, and thus pay less for the share today. The fifth reason is that shares that promise dividends far in the future, that is especially growth companies of course that do not pay dividends at the moment, are more sensitive to changes in the economic conditions caused by unexpected inflation in particular. Higher than expected inflation thus lowers the prices of these shares, as you have to recalculate the discount rate or discount that buyers demand now to take part in future dividends. So these were 5 reasons why stock prices often decline in times of higher inflation. Did I miss anything? Share your valuable insights with me in the comments below, and I'll see you again next time.